Financial Thing Studios is the Peer-to-Peer Lending Essentials podcast.
Welcome to the Financial Thing Investment Essentials podcast. I am your host, as always, Lawrence Samuels, and this podcast is designed to keep you updated to the latest happenings in the peer-to-peer investment and crowdfunding world. I'm very excited today, as I always am, to have a special guest on the podcast. Today we have John Goodall. He is the frontman over at Landbay, which is a peer-to-peer company that I personally invest my own money in. I'm a big believer in Landbay, been using them for a while, love what they do. And I wanted to get John on here to kind of answer some questions about what Landbay does and his thoughts on the peer-to-peer lending world in general. John, how are you doing today? Thank you for joining us.
Pleasure. Good to be on the podcast, Lawrence.
Thank you very much. I appreciate your time. Can you give me a little background on what you did before you actually started Landbay?
Yeah, my background is somewhat unusual, I guess. I was a headhunter, recruiter, and I set up a headhunting business in the City of London. And I then sort of sold that business and sold my stake in that business just before the financial crisis. So this was January 2007. And we work predominantly for banks. I then actually I read economics at university, and I then actually taught economics for 3 years. And as it happened, and obviously I didn't plan this, but that was during the financial crisis. And obviously in the UK, obviously banks like Northern Rock and RBS were having serious problems. And obviously in the US, Lehman. And so it was a very, very interesting time to teach economics. And at that point, I then went after that. I then went and did a further degree, an MBA. And I had always been interested in peer-to-peer lending, and I'd been a sort of early investor on Zopa, and then latterly Funding Circle when it launched. And actually, it was while I was doing my MBA, I looked up sort of peer-to-peer lending models, etc. And I subsequently met and was introduced to my co-founder, Gray Stern, who'd come over here, come over to London, that is, relatively recently from Australia, where he'd worked in real estate finance. And again, he had been sort of looking at the same sort of thing in terms of peer-to-peer business models. And we started talking, and this is now sort of summer 2013. And then, that was the sort of beginning of Landbay.
So 2013 was sort of the time that Landbay became established. Now, was it a difficult company to bring to market?
Yeah, I think it was. I mean, and we brought it to market in 2014. And the reason is, most people in the UK, and again, peer-to-peer lending has changed a little bit over the last few years, because obviously in the UK, institutional investors have increasingly looked at the space. But obviously in 2013, 2014, peer-to-peer was very much a retail investment proposition. And the area that we focused on is a relatively low risk and low yielding and long-term asset class. These are residential mortgages on investment properties or buy-to-let properties or rental properties, depending on where you're from, what you call them. And so therefore we were going to market with a relatively low rate compared for investors relative to some of the others, but with kind of expected losses of very, very low. And we haven't had a late payment, but not being able to put a big kind of 7% or 8% or 10% on your website and saying, look, this is low risk is a tough thing to do. I mean, people are always first and foremost attracted to the rate. So, it took us certainly a bit of time to get traction, because, like any peer-to-peer lender, the first thing you've got to do is build trust, in my view. And you can't do that quickly. That takes a number of years.
Yeah, absolutely. That's got to be a difficult thing too. It's the number one thing that people always ask me is, how do I trust the people that I'm giving my money to? I don't know these people and what's going to happen, but it takes time, right, to build that trust.
Yeah, exactly. And you're right. We are asking people to go online, and put in their card details or whatever, and give us some money based on what they read on a website. And I've always thought about this to where, hundreds of years ago, the grandest buildings in most towns, other than probably the churches, were the banks. And, they had sort of, marble floors and chandeliers. It's certainly in the UK. A lot of them are pubs now, but, they had grand buildings, high ceilings, lots of marble, lots of gold, lots of chandeliers. And the whole purpose of that was, in those days, that was before banking protection and the FSCS. And, they weren't stable, and that whole chandeliers and marble floors were there to try and build trust that they were solid and stable. And I guess peer-to-peer lenders have to sort of do that same thing online, really.
Yeah, that's not an easy thing to do virtually either, because all you can do is provide your information and then people can look further into you and try to find out what they can, but much harder to do online than through an office building. Do you let people come to your offices, like people who are lenders? Do they ever come to your office and take a look around?
I'm trying to think. I mean, I don't think we'd necessarily refuse them. And I'm more, hopefully we probably couldn't take in hundreds of people if they suddenly want to come. But we've had certainly one or two of our larger investors or lenders who've been lending, six-figure numbers have asked to come in and meet or whatever, and we have done. So I can think off the top of my head of two. Mm-hmm. Obviously, there's others that obviously phone up and they can speak to people here as well. But yeah, we haven't had that request that often actually.
Is Landbay open to UK residents only, or do you offer people from other countries, like people from the US? Can they invest in Landbay?
At the moment, you have to have a sort of UK bank account, and so we don't want to mess around slightly with currencies and all that sort of thing. Because at some point, people are going to want to transfer. You assume at some time people are going to want their money out. So having that UK bank account, it just from a transactional point of view makes it a lot easier. And also from a money laundering KYC, it makes it easier. So at the moment, it is that you've got to have some footprint in the UK.
Yeah, and those Americans, a lot of them are up to no good. So you have to. No, just joking, of course. One of the things I think lenders tend to overlook often is the experience of the directors behind the companies and the staff experience behind the companies, and they look so much at the product quality and also the returns. And I think that's a big mistake. I think that having directors who are experienced and know what they're doing is probably more important than the actual product itself, because if they're unable to keep the company going, then at the end of the day, what good is it to have a loan product that's paying you 12%? Because if the company folds, there's so many unknowns behind how that would affect lenders. Do you think that's something that lenders often overlook and focus so much on the product and the return rates?
Yeah, I think that is fair to say on the whole. I think the other thing is not just the company going. I think it is also the credit, and we're in a relatively benign credit environment, and so people without sort of established and probably quite old-fashioned sort of credit professionals and lending professionals who have been through the sort of cycles. I also think is very, very important, because it's the famous Warren Buffett thing, isn't it? You don't quite know what people are wearing until the tide goes out, or I can't remember the exact quote, but something along those lines. And I think it's the exact same as a credit. So I think having that experience there, and a number of people have said it, that fin is far more important than the tech in terms of fintech. And you're right again in terms of the people that run it. And I think there's an element where people do look at it. I think certainly in the UK there's been a case where if you look at the platforms that attract the most retail funds, I assume are the big three, and that's because they've been around longer. And so there's a combination of building trust, but also they've sort of built experience and they've proved that they can run a company, etc. So I think I think people look at how new a company is, and like you say, that doesn't necessarily mean you're looking at the management, but obviously if the management's been running a company for 3 or 4 years, then you might feel a little bit safer than if they've been running it for 1 year.
Is Landbay a profitable company right now? And if not, how long will it take you guys to get to the point where you're profitable?
Yeah, so no, we're not profitable at the moment, and we haven't been to date. We've been lending for 2 3/4 years. Would expect it to probably be another 15 months or so. So middle of 2018 is when we expect break even. We're in our business model is a little bit different to other in terms of we're lending on residential mortgages. These are quite long-term assets. Mm-hmm. So we make a lot more money over the duration of the loan than the sort of upfront product fees, which we personally think is good for investors. We're kind of aligned in terms of our revenue is not sort of based on a one-off, and also therefore it's the margins are quite slim. So ours is a scale business where actually more of our revenue comes from assets under management, if you can think of it in that way, rather than sort of lending fees, if that makes sense. So, and it obviously takes time for us to build those assets.
Yeah, absolutely. So you're projecting sometime 2018 would be the time that Landbay would become profitable?
Yeah, we expect it to be somewhere around about the middle, and we'd expect net to be profitable for the year of 2018 on a month-by-month basis. We're expecting that somewhere in the middle, but exactly where at the moment we don't know.
So in the meantime of not actually being profitable yet, is Landbay venture capital funded?
We haven't taken pure venture capital. We've taken funding from strategic partners. So companies like Zoopla is a shareholder in our business, and they've invested in us. We have some sort of high net worth angels and some private investment vehicles that invested, and a couple of other corporates have invested in us. So to date, we haven't taken sort of that sort of typical kind of VC money. To date.
So, but you're well funded in respect to while you're operating at a loss, you have that cushion to be able to keep funded.
Exactly. Yeah.
John, so with this talk about Brexit and what's happened, much unknown comes along with that. How do you see Brexit as affecting peer-to-peer lenders in the future?
Yeah, and you're right. I mean, certainly, we haven't left obviously the EU yet, and we haven't given notice to leave. Although that's expected to happen next week, and then it's a sort of probably at least a year until we know what Brexit looks like. So, and obviously, people thought that there'd be an impact straight away, and during the referendum campaign, there was expectation of a downturn or property price crash or whatever, and that hasn't happened obviously at all. The last summer was definitely impacted in terms of lending volumes, not just in peer-to-peer but across the board. So actually there's been minimal impact so far, but and I always think peer-to-peer lending is not really an asset class as such. I mean, lending on property and mortgages is very different to development finance and consumer loans and business loans. And so different markets will be affected in a different way. We still see what we lend on as very resilient, and we don't think it will have any material impact. Mm-hmm. Obviously, in the UK, I think there are probably two. So from a lending point of view, we don't see a big change in terms of credit, from a credit point of view.
How do you see within the next 12 months as far as the interest rates on what you're offering lenders? Do you think that will change or will stay relatively stable?
So I mean, obviously where there changes, where there has been an impact from Brexit, obviously is in the UK, rates have fallen, and they're expected to stay lower longer, if that makes sense. Mm-hmm. And so we would expect that to impact peer-to-peer as well if they start that. I mean, at the moment, peer-to-peer rates are, in my view, for the risk that people are taking on the lower risk platforms are, quite a lot higher than the gap between what they get on no risk bank savings and low risk peer-to-peer, I think is quite large in my mind. So it depends on the broader rate environment, but relative to the rate, the alternatives, I would expect rates to slightly fall as more and more people get familiar with peer-to-peer and the IFSA comes in. The one other thing I'd say, obviously, in terms of Brexit having potentially impact, and again, the answer is we don't know, is, most UK peer-to-peers, and not all, are based in London. London is a very global city, high level of, migrants, not just from the EU, but from around the world. And so if that sort of immigration policy tightens up in terms of, finding and hiring developers and designers and other staff, it may become more expensive. It may become harder. So that could have an impact depending on what the immigration policy post Brexit looks like.
Do you foresee maybe in the next 12 months, if you had a crystal ball, do you think that the lending rates for Landbay are going to be relatively similar to what they are now?
For investors?
Yeah, for lenders, yeah.
Yeah, I'd probably say they're probably slightly below where they are if all stays the same. So if UK interest rates stay where they are, and the expectation of UK interest rates stay where they are, I wouldn't see them rising. So I'd see them more chance of them falling than rising. LIBOR in the UK is still falling slightly, so obviously that's market rates. Now, there's two things that have happened in the UK. Is one, people are expecting interest rates not to move until I think autumn 2018, so that's 18 months away. And they're currently 0.25%. So, it's a long, so is that lower longer? But then actually earlier this week, the inflation numbers were slightly higher than people expected. So that could change expectations if that continues, with rates maybe rising earlier. But, there is definitely uncertainty in not just the UK economy, but the European economy as well. But I think there's probably more chance of rates going down and up over the next 12 months.
Peer-to-peer lenders, I always say, can be a little difficult to keep happy in investors because they have their eye on this return rate and they want to receive a certain amount. If you have these interest rates falling to a certain point, how do you keep the lenders and the investors happy to the point where the rates fall? What if they fall to a point where they figure, well, the risk is not worth it anymore at those rates? How do you keep these lenders happy?
Yeah, I mean, it's a balancing act to match that supply and demand on both sides. I mean, one thing that's had obviously made a difference in the UK is the peer-to-peer lending is now ISA eligible. And so for people that, we're fully authorized, and so we've launched an ISA, a lot of the platforms aren't yet. And so straight away those returns become tax-free. So, and there's a lot of money sitting in ISAs in the UK earning not a lot. So that money moving across from cash ISAs into peer-to-peer ISAs or innovative finance ISAs, I think will have a material impact on the whole industry in terms of actually, the people refer to a wall of money. I think that's probably exaggerating it, but that amount of money coming across into the sector is enough to kind of suppress interest rates. And so it is supply and demand. And from our perspective, we as a lender, and I mean this as a peer-to-peer lender, from a borrower point of view, we're not here to kind of make up the numbers. We're in terms of from a buy-to-let perspective, we want to be challenging the challenger banks, and lending a meaningful amount of money and to prime customers. So what we don't want to be doing is having just a high cost of funding, so that actually we can only pick off the stuff that the banks don't want. We want to compete with them on both service and price. And so hopefully, and it goes back to that point where they do, we have to educate our investors that actually, from a risk point of view, we want to be, we need to be competitive with banks. If they want to be funding loans that banks would do, which I think is in their interest rather than stuff that banks wouldn't do. Yeah. Or higher to value stuff. So it is, and we've always had that because we're a lower yielding platform. I think in some ways, it's slightly easier for us to lower rates because our propositions are a lot more about security and low risk, etc. And I don't think there'll be huge rate cuts going forward over time, but I think it is a case where we've got to ensure that our borrower products are in line with where the market is.
So, John, speaking of the ISA, the way that the ISA is set up, so if you invest money, say for 2017, you can only put your IFISA money into one product, correct? Like you can't split your £15,000 5 different ways between 5 different companies for this upcoming year.
That's correct. So as it stands today, your annual ISA limit, which is based on the UK tax year, which is April to March. So we're actually at the end of one kind of period, if that makes it almost now. But yeah, you could only have one innovative finance ISA. You don't have to put it all into that. So, for example, of that 15,000 allowance this year and 20 next, you could put, for argument's sake, 5,000 into peer-to-peer lending on Landbay, 5,000 into a cash ISA with Barclays Bank, and 5,000 in a fund run by Fidelity or whoever. But what you can't do is put 5,000 into Landbay, 5,000 into Funding Circle, and 5,000 into Zopa.
Does that rule make it more challenging to get lenders to put money into an IFISA? I'm sure there's people that want to maybe take that full allocation into peer-to-peer lending, but they don't necessarily want to put the whole 15K into one peer-to-peer company. Has that made the investment side of the ISA challenging?
The short answer is we don't know, and because we launched our ISA mid-February, so it's been going 5 weeks or so. We've had we've had a minimum investment of 5,000, and we typically find that people either invest 5,000 or they invest the full amount, 15. So broadly speaking, there's very few people doing 10,000. So either people are comfortable or they just want to get some exposure. And if people are doing the 5,000, that means either they're not using their full ISA allowance, or obviously they're keeping the other 10,000 in stocks and shares or cash. I think over time there will be aggregator sites that allow some mechanism for this to happen, but also there are also a number of people that who are transferring in ISAs, and actually that is as big a market for us as the fresh ISAs. So they've got all these previous years worth of ISAs, and they're deciding to move them from cash, which is paying 0.5% maybe, to the companies or products like Landbay. And on that, then they can split it up. So they can then turn around and say, actually, I've got 50,000 ISAs, I pick 5 peer-to-peer lenders, and I put 10,000 in each. So people can diversify in that way, but as a one-off hit, you're right. So you've got to decide whether you do the full amount into one peer-to-peer lender, or you just use part of the allowance.
Yeah. What was the reason for the government creating that rule to where 1 year you can split it up from past years, but for the future upcoming year you can only put it into one place?
I really don't know. I have no idea, I'm afraid. And I suspect it's something that will get looked at in terms of particularly of the current ISA money, whether you can split it into 2 or 3 different peer-to-peer lenders. But I don't really know the rationale behind it.
Yeah, typical politics. Nobody really quite understands why these things happen. They just happen, and we have to be okay with it. How about the popularity of the ISA for Landbay so far? Has it been a success, would you say?
Yeah, it has been a huge success, actually. And again, we didn't quite know how big it was going to be. We haven't marketed it, so we've pretty much just, it received some PR. We've obviously mentioned it to our current investors, but yeah, it has been, and this is ISA season, obviously, because the tax year is end of March, so people are in the last 2 months of the year, February, March, are using those allowances, and then obviously in April, those that are organised, do at the beginning of the year. So you do have a sort of 3 or 4 month window when a high proportion of ISAs are done between February and say May. So yes, it is. It's definitely a large part of our funding, and we expect it to be, from a retail point of view, probably the majority of our retail funding to come via the ISA mechanism. And in the UK, for those that aren't familiar, there's probably 70 billion a year going into ISAs, and at the moment, most of that's going into cash ISAs. So, when you think about how big the peer-to-peer sector is, I know it's always dangerous to say small percentages of large numbers, but even if only 5% of that goes into peer-to-peer, that's quite a material change to the amount of money that's on peer-to-peer platforms in the UK right now.
So growing up in the UK and having spent a lot of time over in the States, what I'm starting to understand is that British people are inherently like to save money. They seem a lot more saving orientated than the US. Over in the US, I think the statistics are that 1 in 2 people don't save anything at all for retirement. So that would play well into peer-to-peer companies receiving a lot of interest in investments into the ISA, which is good for you as a company.
Yeah, and also the government has, in the UK, it's increased those ISA allowances. So particularly the sort of the government where George Osborne was Chancellor, So those thresholds. So next year they moved from 15,000 to 20,000. I think it was 15 the year before. The year before that was 11. So over a 3 or 4 year period, that ISA allowance has doubled. And also the tax relief on pension savings have slightly reduced in terms of how much you can put into them. So ISAs are being seen as kind of almost the main saving for retirement vehicle, or certainly alongside pensions. So there's a bit of a structural change going on as well, which, with the ISA being such a large part of the savings market.
Yeah, it's amazing here in the US. So the maximum that you can put into a personal IRA is $5,500 a year, which is a third of what they allow in the UK. So it's amazing to me. It's such a big difference. Lenders who use Landbay, they log onto the account. Seems very simple. Coming from the website development world, I know how challenging things, the tech side of a business, what you do can be. Is it a large financial expense for you as a company setting up a tech system like that, being able to work it the way it does?
Yeah, it is actually, and certainly if in terms of our employees, and there are 22 of us at the moment, and the largest individual team is the tech team. Mm-hmm. If that makes sense. So it is quite a material expense, and like you say, our platform is very well. Our tech platform is very well architected. The architecture is very strong. It's modern. It's microservices, but it's still, like you say, it's quite simple in terms of functionality today. But it's still there's a lot of work that's gone into it. And when we launched and we used a sort of third-party solution that was developed for us, but it wasn't developed in-house. And we always knew it was something we wanted to develop. That was very much the testing sort of platform and infrastructure. And so we effectively started building our own one again. It took us 18 months with a team of sort of, at that point, anywhere between 4 and 6 people working on it sort of around the clock. And there's still a lot of work to do and to develop it further and to add functionality and features. But yeah, it is like I say, from the outside it looks simple and easy, but there's a lot going on behind.
Yeah, hopefully now lenders will appreciate more what they do when they log in, and it seems so simple how much work goes into putting something like that together. John, what would you say is the biggest single challenge that you face as a peer-to-peer lending company?
Yeah, I mean, well, to date, it's definitely been. I mean, we're you asked if it was quite hard getting it started, and the answer is obviously definitely yes, getting traction, but also but mortgages typically take sort of 2 to 3 months to complete, and obviously retail. We're always trying to, from a purely retail point of view, that liquidity matching where you're trying to sort of ensure that you've got enough funding for all the mortgages you're committed to, but at the same time you're not overfunded and people's money's just sitting around doing nothing. And that matching is that's a challenging part of the business. Actually, as we take on institutional lenders, it actually reduces or even removes that problem effectively, because there's kind of capital on tap if you run a shortfall, if that makes sense, and you can lend more. So I think that there are always challenges that come at different times of the business, and I think really over the next 6, 12, 18 months, the key thing that we've got to do is scale and scale materially, and we certainly have the funding now to do that from institutional lenders, but also equity capital. But the key thing there is then to educate both borrowers and lenders around that. From a borrower's perspective, and actually, as far as they're concerned, the sort of mortgage or loan they're getting from us is identical to one they're getting at a bank. We're just quicker and better, but fundamentally the legal paperwork's the same. They don't, there's nothing sort of for them to worry about. And likewise for retail investors, just to really, educate them on that risk piece. And I think you made some very good points about it's not just the rate, it's kind of what's behind the business, what's behind the loan. That 7% isn't always better than 4%.
John, you seem like a person that has a good sense of humor, right?
Yeah, I guess so.
All right. What do you call a bull that likes to sleep a lot?
I have no idea.
Bulldozer. Like to throw a joke in there, just to keep you laughing. Yesterday, I was talking to my sister, and she lives in the New Forest in Dorset, and we were talking about finances. She's heading towards that retirement age, trying to figure out what to do investment-wise. She's been used to going towards your more traditional way of getting a financial advisor, the advisor putting into some unit trusts, stock portfolios and things like that, charging some substantial fees to do so. I'm very much into DIY investing. So I was talking to her about peer-to-peer lending. She's never put one single pound into peer-to-peer lending. And she said to me, well, first thing she said to me is, she said, why do I look like a homeless guy? Because of this beard that I'm growing out. And I'm trying not to look like a homeless guy. But the second thing she said is to me, it sounds like a very, very risky thing to do, to put money into peer-to-peer lending. And so I'm trying to explain to her the different risk elements and how risky I considered it to be. If you were to take an unbiased look at Landbay and put it on a risk of 1 to 10 on the risk scale, so 10 being the most risky, where would you see Landbay on that risk scale?
So 10 being risky?
10 being the riskiest investment you could, within peer-to-peer, not within the total, like stocks and shares or banks, but just within peer-to-peer.
It's not comparative. I mean, I would say, and I generally mean this, and obviously I lend on Landbay. I would say 1. I think we're at the very low risk end, and even if we went through a downturn, yes, there would be, you'd expect there to be defaults and there'd be some losses on some loans. But if you look at what's happened in buy-to-let in 2008 and even in previous crises, losses would be running at worst you can always make things a little bit worse, but losses would be in the magnitude of 0.5% or 1%. And so when you think about something that's giving you, currently a return of somewhere between 3.4 and 3.7, yes, that would eat into your return. But to get to the point where actually you're losing capital net, you would need to be in quite a severe downturn. I mean, of course, these things are never impossible. Of course, they're not. So you can always lose money, but actually, the possibility of losing money is very, very low in my mind. Okay.
One of the other things beginners ask me, it's quite a difficult question to answer because everybody's situation is different, but I get asked a lot, what percent of my liquid net worth is a safe amount to put into peer-to-peer lending? What advice do you have for people that, out of 100% of their net worth, what advice do you have for them trying to figure out what would be an okay amount?
Yeah. So one thing I'd say, and I think this is a risk that people don't really talk about, and I view this risk on peer-to-peer lending, and this includes Landbay, as greater than the credit risk. And so right now we have a secondary market. Lawrence, I am answering your question, but
That's okay.
We have a secondary market. It's automated and it's very liquid. So if you put money onto Landbay and actually 3 days later you think, actually, I need to get some of that out, we don't charge a fee for it, and you'll typically get it back within 48 hours. And I say typically, I mean, it'd be very unusual not to get it back in 48 hours. And that's always been the way. And yes, occasionally around Christmas, it might be 3 days, 4 days. But broadly speaking, getting it back can't be in a week. If we hit a downturn, then I think that liquidity would get stressed. So I think that be able to get access to it, where suddenly actually people get worried and inflows dry up and more people get nervous, and it's equivalent of a run on a bank, if that makes sense. And it's not a run because they're loaned, but therefore the queue for people selling becomes greater than the queue for buying, and so therefore it takes time, and that is a genuine risk. And so one thing I would say to people is, don't just think about the credit risk, and you should think about the credit risk, can you lose money, but you should view, even though most peer-to-peer platforms offer a secondary market, you've got to assume that in a downturn that secondary market is either it dries up or it becomes not very liquid at all. So going to your question in terms of how you allocate money, I think a lot depends on how much access you need to that money and when, as opposed to necessarily just what you're looking for return. So I think thinking I can always get my money out of peer-to-peer, I think is wrong. Whichever peer-to-peer lender you're doing it with, and if you're diversifying, because in a downturn it will affect them all. So I think you always want to have a decent chunk, depending on your circumstances, that is sitting in genuine either instant access, or you have certainty that if you 30-day notice or whatever it might be, and that would the only thing that can really give you that is a bank and bank deposits. Without losing money, if that makes sense. So I think you've always got to have that chunk. And then I think, within peer-to-peer lending, it's a good way of generating some income in a relatively low risk sort of fashion, if that makes sense. Then, I think long term, on a 30-year view in terms of pensions, if you're putting it into stock markets, generally speaking, you should outperform most asset classes on a 30-year view if you consider dividends or so. So it's, in my mind, it always sits between those two. It's not as volatile, obviously, as the stock market, but it's not as liquid as cash. And so, in my mind, it does slightly depend on when people are thinking of buying that house or whatever they're saving up for, or the chance that they might need quick access because of something, some event that is likely to happen, or retirement. But based on that, it should be, and I think it also depends on where you are in your life. I mean, I think a lot of the lenders on peer-to-peer platforms are people that are retired, and I think they do use it as an income generator, as in they're looking for the income, as opposed to they probably don't need access to the capital, or if that makes sense, because they've got enough regular income to assume. So I know I haven't really answered your question, but I think people should be looking at all those three different pots, if that makes sense.
Yeah.
And thinking what achieved. And I think liquidity, and it's more how long do you want to tie your money up for different pots, as opposed to necessarily the risk of different pots, if that makes sense.
Yeah. Well, John, it's funny that you mentioned those things, because the questions that I usually ask from people that are not involved in peer-to-peer lending but want to become is not so much about, the liquidity side of things, but if everything collapses, what can I afford to lose and be still okay with it? So that it's almost like they're looking at the worst case scenarios more than the actual liquidity side of things.
And it depends what you mean, Bob, because I think business in the UK, they have to have sort of backup plans that if the business itself goes out, that lenders still get their money and their assets are managed, and that's another thing. I mean, if those businesses do go wrong, then actually the liquidity dries up in totality. But actually, it doesn't necessarily mean your loans go bad. They'll still get serviced. You've got to have backup servicers and that sort of thing. And on asset backed, you're never going to lose 100%. There's always some value in the asset. But yeah, I think liquidity risk is something that I think is slightly misunderstood and maybe not appreciated. And I think people do appreciate it. I mean, if you look at in the UK, obviously money on banks. If you look at the rates on, say, 1 year fixed rate bonds and 5 year fixed rate bonds, there is definitely a premium for putting into 5 year, but most money goes into 1 year. And I think a lot of people, certainly in banking products, want they almost lump all their money so they can have it instant access. And I know someone who's retired who has sort of 250,000 sitting in various different investments, and probably 200,000 of it is sitting so that she can get access to it. And in my mind, that's it's very unlikely that she's ever going to suddenly need £200,000.
Yeah.
Suddenly. So I think people generally have probably got too much sitting in instant access cash accounts, that makes sense, there, because they're generally they're generally free money for the banks. And I think an approach where you think, well, actually, I might need access to 25% of it then, I might need another 25% within a year, and thinking of the kind of financial planning in that way, which generally people don't.
Yeah, yeah. The big problem too now with the stock market the way it is, that a lot of people are nervous to put their money into that, thinking, well, what's going to happen with the financial market? So, but then it's, people have been saying that for 3 or 4 years. Oh, the markets are going to come down, they're going to crash soon, and it just hasn't happened. So, my experience, a lot of people are sitting in cash, sort of waiting for that collapse to happen, and then they figure, oh, we're just going to get back in. Problem is, they don't know when that time is to get back in. When's the good point? When's the low point?
Yeah, and I know people who have done exactly in the UK property market for the last 15 years, thinking, oh, it's the wrong time to buy a house, prices are too expensive,
Yeah.
and they sat on the sides and they can't afford to buy a house anymore.
John, you had mentioned before that you actually invested in peer-to-peer. Do you continue to invest in companies outside of Landbay as far as peer-to-peer, or is your focus strictly on Landbay now?
It is pretty much Landbay. I've got some, and I haven't. So I've still got some old loans that I haven't sold, but I'm not putting fresh cash into them on Zopa and Funding Circle. I'm just they're kind of in runoff effectively. I think some of them there might be a relatively small amount of money on auto reinvest on those, but yeah, I'm not investing in many other platforms at the moment.
What do you think that it's going to take for peer-to-peer lending and crowdfunding to be seen as a viable form of investing for the general public, who still view it as a very risky place to put their money?
I think part of it is I think the IFSA does make some difference there. I think there are two things to it. I think the IFA market, the independent financial advisor market, right now that they are not. I don't think any of them are advising on peer-to-peer and are using it as a viable product. I think largely because they can't make fees from it. But at some point, as the industry grows, they will do, and particularly when there are these aggregator sites and they can then advise that sort of thing. And I think these things naturally, as they build up their own steam, so as all these lenders become bigger and people become more familiar with them, it's that building trust thing that happens, I think, naturally over time. I think, probably it is a little bit of a downturn. I think, that every peer-to-peer lender is asked, well, that's all very well. What happens when, for us, property prices fall, or we hit a recession, or whatever it might be? But we hit some form of downturn, and we say, well, we think this and we believe this. And if you look at buy-to-let stats, what happens in a downturn? And we've done some modelling, and we've done stress tests, which I think are all good things to do. But we can't turn around and say we've lived through them. And our lending team has, because they've worked for other lenders, so we have a sense. But I think bizarrely, getting through a platform, going through a cycle where most platforms survive, as businesses, but also their loans perform well and far better than expected, and people don't lose money. Like you say, it might eat into returns a little bit. I think it is something that it will allow people to turn around and say, well, actually, we've been operating for 10 years, we've been through the cycle, and actually people always made money even in the worst year. Yeah,
so that's something that Zopa has used quite successfully in their advertising, that they've been through the downturn. I think that's created a somewhat confidence in the lenders to be able to put their money in there, knowing that has happened.
Yeah, I think that's fair, yeah.
And finally, John, what does the future hold for Landbay? Do you have anything that you could share regarding the future, whether you're going to have any additional products or whether things will continue to motor on as they are now?
In the short term, we're buy-to-let focused. I think there'll be some additional products within sort of buy-to-let, both for borrowers and investors potentially, but they're still fundamentally investing in the same asset class. And for us, it really is just to really grow in a quickly, but at the same time in a safe fashion in terms of from a credit point of view, and to broaden our sort of funding so that we can do more sort of lending within the mainstream buy-to-let piece. So it is really just growth, add in some ancillary kind of areas still within buy-to-let in terms of products, and we'd expect to do that later this quarter two, or sort of just for the summer. So yeah, it's more of the same really. But we've built over 2016. We've built a lot of the foundations for scale, and now we have funding in place to scale. So this year and beginning of next is when we actually try and achieve scale. And like we said earlier, to achieve that kind of break even or profitability for us, I think again proving viability. Again, it will reassure investors where actually, the business is on a far more solid background if you're not reliant on raising more equity. So that again is a key point for us as well.
So if a lender is listening to this now and sort of on the fence about whether they should put some money into Landbay or not, what's your pitch to them?
Our pitch is, we most people who work in the business lend on Landbay. They back it. They believe in it. Peer-to-peer lending is, like you say, from the outside it looks quite complicated, but it is quite straightforward. We lend on the same sort of loans that banks do, and they're all very. Our average loan to value is around about 65%. And I'd say just try it out. I mean, we have a minimum investment of £100. We haven't had one loan that's defaulted. Sorry, not even defaulted. We haven't had one loan that's even had a late payment to date, and that's in 2 years and 3 quarters. Obviously, at some point, I'm not going to be able to say that, but as of now, that's the case. So in my mind, it is low risk. Doesn't mean it's no risk. But I'd say try it out, and obviously try Landbay out, but try others out too. I mean, some people are looking for slightly higher return. Some people are looking for more stability and simpler. And try peer-to-peer lending out and try a few.
Do you have anything else that you want to mention or that we might have missed?
Yeah, well, one thing I would say, and again, I think it's a common misconception, not a common misconception, but it goes back to what I was saying about what happens in a downturn. That people always say to us, what happens when property prices fall? And that's often the first question when people phone up, or investors or journalists. And actually, that's not what drives buy-to-let. Buy-to-let drives, if landlords are getting rents paid, then regardless of what's happening to the property value, they're going to pay their mortgage, if that makes sense. So yep. The key thing is that cash flow is really what protects borrowers. And then in the background, you've got a charge on a house that is still is an additional and very powerful extra form of security. So I would bear that in mind for any investors that are thinking. And if they're in the UK, they have about 2 weeks before this year's ISA allowances are over.
Yeah, absolutely. And the thing too about the UK property market, it's always been a relatively stable investment. It's not like the US where they've had a 50% downturn. I think some of the worst drops even during the 2008-9 crisis was 10, 12, 15% drop.
Yeah. I mean, so I think it's about 17, 18. I think in the worst areas. And in certainly in London and the southeast, I think it bounced back within 18 months. Yeah. In terms of back to where it was, prior to the crisis. So, we view it as very stable market. The UK the population is growing, not just from migration but demographics. The number of households are increasing. We think it's a good place to invest.
Well, John, thank you very much for taking the time again. Really great to learn about the things that Landbay are doing and the people behind it, and certainly gives me a lot of confidence putting my own money into your company. And to all the listeners out there, I hope you enjoyed it. If you have any comments or questions, please feel free to drop us a line. Don't forget to sign up for Landbay. I'll leave a link in the description below. And don't forget also to check out financialthing.com, where we have all the latest reviews on the peer-to-peer companies that I personally invest my own money into. Hopefully you get a lot of good information out of that. And we appreciate your time again, John. Thank you so much.
Thanks a lot, Lawrence. It's been fun.